Hi, I'm Christian Chan, CEO at AssetMark. In this quarter's update, I'll discuss the tension between growth and inflation and what that means for markets. There are three charts I think really summarize this quarter's dynamics. So we all know that the labor market has recovered dramatically since the peak of the pandemic in 2020. We've seen some signs of weakness, but overall, the labor markets remain in really good shape. One effect of a strong labor market is strong wage growth. In this chart, we're showing year-over-year wage growth in the blue line. As you can see, wage growth is running about 4.7%. In the orange line, we're showing year-over-year headline inflation. This includes food and energy costs. This is running at about 3.3%. Since the start of last year, wage growth has been higher than headline inflation. And at the risk of being overly reductive, as long as wages are growing faster than the cost of living, the consumer should be okay. Two other things to point out here. First of all, during this period here, inflation was so much higher than wage growth that a lot of people are still working to catch up to higher prices. Secondly, these numbers represent the average person in the US. If you look at different income tiers, we're starting to see signs of stress in lower income households because they tend to have more exposure to floating rate interest payments from credit card debt. All that being said, the key takeaway from this chart is that at this point, the average US consumer is in pretty good shape. Let's move from the consumer to the corporation. In this next chart, we're showing two components within the ISM survey. The Institute of Supply Management surveys purchasing managers at companies around the nation and asks them a series of questions. One question asks whether purchasing managers are seeing input prices rising or falling. In orange, we show the percentage of responses indicating that input prices are rising. As you might expect, this is a pretty good indicator of future inflation. You can see that price pressures have really eased since 2022 as supply chains have healed, but they've started to tick up again. The blue line shows the percentage of responses to another question. Are new orders rising or falling? As you might expect, this is a pretty good indicator of future growth. Here, we see that growth has declined over the last couple of years, but so far it's staying pretty resilient. The key takeaway from this chart is that in the corporate sector, we're seeing both growth and inflation slowly slow, but growth looks like it's slowing more than inflation. One way we connect what's happening in the economy to sentiment in the market is by looking at expectations. On this chart, we show economic surprise indexes. These indexes measure the extent to which expectations for economic growth data, like GDP growth and consumer spending, are better or worse than expectations. If the line is above zero, that means growth is surprising to the upside. If the line is below zero, it means that growth is surprising to the downside. And what you see is that growth was surprising to the upside for much of 2023. And then in February of this year, it started to surprise to the downside. Economic surprise indexes by their nature are very cyclical because what happens is that if you continue to get upside growth surprises, analysts start increasing the growth expectations, and eventually those growth expectations get too high, and then we start to see downside surprises, and then the whole process happens in reverse. We see this exact same behavior with analyst earnings expectations. That's why economic surprise indexes are great ways to connect the economy to the markets. My key takeaway from the blue line is that economic growth was unexpectedly strong for much of 2023, but we experienced a growth slowdown in the first quarter of this year, which has caused analysts to start lowering their growth expectations. Now let's take a look at the orange line. This is the same type of surprise index, except it measures inflation surprises. This explains so much about why the bond market has behaved the way it has over the last year. You can see that inflation was surprising strongly to the upside earlier in 2023. Those upside surprises decreased steadily over the year and then really dropped in the fourth quarter of 2023. That's when we started seeing analysts lowering their inflation expectations, and this included the analysts at the Fed, if you think back to Chairman Powell's December press conference. Not surprisingly, we also saw Treasury yields fall from 4.6% to 3.9%, and 2024 rate cut expectations moved from 3 cuts to 7 cuts on the back of these lowered inflation expectations. This year, inflation has started to surprise to the upside, and markets have completely walked back those expectations. The key takeaway from the orange line is that inflation expectations probably got too high, and we're now starting to see downside surprises to inflation data. If this trend continues, this should offer support to the bond market. So how does all of this impact our outlook for the market? Growth expectations have come down over the last couple of months. I wouldn't be surprised to see some equity market volatility as growth expectations bottom. As long as we don't have a recession, which is our base case, that would set up the potential for growth surprises, which would be supportive of equity prices later in the year. Similarly, inflation expectations probably got a bit too high over the last couple of months. If we see a few more soft prints like we saw in June, that would be supportive of the bond market. Thanks for watching. We'll talk to you next quarter.